This is TreppWire Week in Review for week ending March 3rd, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, hawkish comments from the Fed on the heels of last week's hot inflation print, and retail earnings show consumers have shifted their spending while consumer confidence slipped last month. In other economic data, manufacturing remained in contraction territory. February home mortgage rates hit 4-month highs and home prices fell. And again, more data point to a tight labor market. Manus, 10-year Treasury yields climbed above 4% for the first time in months, and the yield curve hit the steepest inversion in 42 years.
It's all about rates right now, right? That has really put investors on their back heels. We saw a terrible February for equity returns. We saw a huge uptick in interest rates, and it was driven by exceedingly strong economic data, from the jobs report to the retail sales, really across the board in every segment other than earnings, which were kind of meh. We really saw evidence that the Fed will have to keep its foot on the gas when it comes to raising interest rates. This week, you referred to the remarks from the president of the Minneapolis Fed, who said that 25, 50 basis points, it's really a coin toss at this point. And that's coming on the heels of rates really moving considerably higher. You mentioned the 10-year, which closed today, Thursday, March 2nd at 408, which is concerning enough. It's getting close to where it was at its peak a couple of months ago. But even more alarming is further down the curve. The 6-month is at 520. The 2-year is now approaching 5%. And when we look at something like the 5-year, which CMBS lenders, CMBS issuers were looking at for salvation to keep the issuance pipeline churning, that's up 84 basis points over the last 30 days. That is now 4.35% or thereabouts. And people were hoping that they could lend on the 5-year to give their borrowers some more flexibility and maybe some interest rate relief as an alternative to going long 10 years and locking in 7% handle coupons. And now that's really kind of off the table. So what does that mean? What does that mean for the broader economy? I think that the risks of having a bumpier landing are much greater now than they were 30 days ago, no doubt. But certainly this is putting downward pressure, sizable downward pressure on commercial real estate valuations, the pace at which transactions are taking place, the sales activity, and everything else in between. Not a great month, not a great week for the CRE or CMBS markets, to be sure.
Yeah, so you covered a lot there, Manus, and I agree with you that rates are the central theme. And you mentioned the inversion on the 2 and the 10. If you look at where they're at right now, about 90 basis points spread, it's the worst negative reading since October of 81, when it was inverted 96.8 basis points. So something to keep an eye on. I know we've been watching it closely for the last several months. You mentioned the Minneapolis Fed president. Similarly, the Atlanta Fed president, Raphael Bostic, said he's comfortable with 5 to 5.25, target proposed rate that they've been talking about since last year. But he did warn that rates will need to remain high until well into 2024 was his quote. So, we've talked about for the last couple of months, maybe some optimism around the second half of 23. It sounds like, some of this is not just about the rate itself, but the hold period in which the Fed's going to maintain those rates. And we start hearing things around well into 2024, I think that just, exacerbates the issues we're having with the current interest rate environment, refinances and everything else. Then you start looking out into even 2025 refis, which we haven't spent a lot of time talking about at this point. So, some of the other stuff that the Fed's dealing with, personal consumption expenditures, price index, jump unexpectedly in January. It was up 0.6% for the month and 4.7% from a year ago. You mentioned soft landing. There was a white paper put out by the University of Chicago Booth School that basically, they coined a term which was kind of interesting, immaculate disinflation, saying that that's not likely if history's any guide. but there's a quote in the paper that says there's no post-1950 precedent for a sizable central bank-induced disinflation that does not entail substantial economic sacrifice or recession. And so what that means, historically speaking, is more rate hikes and job losses before inflation gets to that target rate of 2%. So I think, maybe the worst is still to come. And just kind of some other thoughts around that and the housing market. We kind of give an update weekly on the housing market. Mortgage rates, which had been receding over the last couple of weeks, they rose. They're at a 4-month high, closed today at 7.1%. And this is kind of an interesting dynamic in the sense that U.S. pending home sales rose 8% in January. So it's the first time in a while that we've had 2 months in a row in terms of home sale growth. But if you look back at those, mortgage rates were down, about to 6%. And now with rates rising back up, we're expecting to see, significant slowdown on that side. The mortgage demand has been low, 44% lower this week than the same time a year ago. So a lot of interesting stuff in the marketplace. I know we're going to talk about earnings, which came out this week. One last bullet here. The job market is still super tight. So if you look at number of Americans filing new claims for unemployment, it fell again last week. So, just more sustained, labor market strength, which just adds additional fears that the Fed's going to have to continue raising rates for longer.
Yeah, we did have that 60-day respite a month or two ago where it looked like we might kind of wiggle out of this. And by wiggle out of it, I'm really speaking to those borrowers that had the interest rate caps and the extension options that they had to reach into pocket to buy caps to keep their loan rate from exploding higher and so forth. And there was a window in there where the 10-year was at under 340, not that the 10 years has any impact on these interest rate caps, but across the board, even at the lower end of the interest rate curve, which really drives how expensive these caps are, we saw a leveling off and a dip, right? We were all in as market watchers on the fact that we had seen peak inflation. The Fed was ready to take their foot off the gas. And what a difference 30 days makes, right? This is a 180-degree change in narrative right now. We are back to July of 2022 in terms of expectations for interest rates, for borrowing costs, for mortgage rates, and for cap pain.
And we did see retail earnings that you referenced, Lonnie, a number of retailers that we were watching closely. Numbers include Kohl's, Target, Macy's, Best Buy, American Eagle, and Nordstrom just announced. And there were some key takeaways, not just in terms of their performance and the consumer health, but impact to real estate.
Yeah, so it's interesting. Target, as an example, they had fiscal fourth quarter earnings of about $31.4 billion, which beat estimates. Their CEO called this time the most turbulent business environment many of them had ever seen. Same store sales were relatively flat. They increased 0.7%. But to your point on the real estate side, the company announced it was going to continue making capital investments. They actually set up to about $5 billion for the year to update about 175 stores nationwide. They plan to open about 20 new stores and grow what it's calling its sortation center, an ability to expand same-day services to allow customers to return unwanted items via drive-up. Really interesting. I've actually seen a couple of these Targets undergoing renovation near where I live, and they're adding a much more systematic, parking structure, canopies. It looks like they're going to have some sort of, as we say here, package drop-off location. So they're really leaning into this omni-channel type of presence at the retail location. So it's, they're kind of firming that up here with this announcement. If you look at Macy's as another example, net sales were $8.3 billion, which beat estimates. Sales were down 4.6% in the fourth quarter, but they reported a bigger profit during the holiday quarter as a result of strategic markdown promotions. Fairly good news for Macy's there. On the real estate side, it says they plan to open more off-mall stores. So these are smaller format stores. Right now, accounts for about 10 of its total operating portfolio of 722 physical locations, 8 of which are Market by Macy's, and 2 of Those storefronts are called Bloomies. And so the idea here is that they plan to increase their footprint in some of those non-traditional, brick and mortar type of non-mall stores. So interesting to see there. We'll see how the market reacts to that. From a non-real estate perspective, Kohl's, they were kind of the losers here. They reported a pretty big surprising loss. Sales were down 7% in the holiday quarter. Same store sales dropped 6.6% in the quarter. They saw net income swing dramatically to the tune of about $273 million loss. And they really just missed out. They missed out on the pandemic spending surge. They missed out on the holiday surge. I think it's interesting times for Kohl's. And we've talked about that for the last year when they had an activist investor trying to take them over. There's a pretty large footprint exposure for Kohl's in the marketplace should they not remain viable as a retailer.
Yeah, I think absent in these retailer announcements was some of that angst that we saw 6 months ago about supply chain and inventory. It seems like there was neither panic nor euphoria with these retailers, and maybe that's the best way to be, right? They kind of went right down the middle in terms of performance. It wasn't great, it wasn't terrible. And considering that you see more and more headlines right now about especially younger consumers having been very aggressive in taking on debt in the last couple of years and spending and maybe being tapped out, the fact that they kind of put their earnings more or less right through the uprights, there were some outliers there, probably a good sign, on top of the fact that other than the going concern issues for Bed Bath & Beyond and Tuesday Morning and this week Corner Bakery, we haven't seen an enormous wave of store closings. It was more episodic store closings than epidemic store closings.
And yet we did see Best Buy announce, obviously, that they're having some struggles. No one's buying electronics like they were during the pandemic. They did say they announced closing about 20 to 30 of their large format stores.
Yeah, I think it'll be a slog for Best Buy. The tailwinds were with them during COVID, right? Everybody needed the home entertainment system and for work, the Zoom setup. And so people are out there with microphones and headphones and so forth. So I think it'll be a struggle. But Best Buy's footprint is so big that 20 or 30 stores I would probably put in the episodic category, not something terribly alarming. That's a pruning number to me and not a panic number.
Yeah, I would say those are probably low-hanging fruit, non-performing stores that probably have some, individual issues that they can just address by closing the store. I would agree with you, Manus.
So the delinquency report we've been talking about, and we are looking at putting that out tomorrow. The delinquency rate jumped.
Yes, we've been waiting for this for some time. People have been speculating since last summer that with borrowing costs up and with maturing loans struggling to get refinancing, especially in the mall and office space, that we were due for an uptick. That uptick had been elusive. We had seen rates really hang at 3% or below for many months. In fact, last month, we had our second lowest reading since June of 2020 with the January delinquency report. Whether this month's report for February 2023 is an inflection point or not, only time will tell. But we did see a big uptick this month, 18 basis points. It pushed the delinquency rate up to 3.12%. The 18 basis point increase was the second highest since June of 2020. Only December of 2021 saw a bigger uptick in delinquencies. And it was more or less across the board, but some property types were worse than others. Leading the way higher was that office segment with a 55 basis point uptick in February. We've seen the headlines. They've made their way around the market of loans reaching their maturity date and not paying off or going 30 days delinquent. The biggest one being that CPT loan backed by 7 properties in the US and New York and San Francisco predominantly, that being the big bellwether that went delinquent this month. So concerning news, and probably not the last hike we'll see. Look for that report tomorrow from the fine folks at the Trepp research team.
Yeah, I'm going to go out on a limb here, Manus, and say we're going to see a couple of months of increase in the delinquency number here. I think multifamily, if I'm looking at this month's report, pretty significant jump for them, 27 basis points, office at 55. I think we're going to start seeing those types of things over the next couple of months based on what we've seen in the news and the headlines over the last couple of weeks.
There's really nothing, unless maybe you could think of something, Lonnie or Martha, that would change that direction upward. There's no downward pressure, right? Anywhere you look across, reading every tea leaf, right? Lending conditions are tighter, borrowing costs are tighter, valuations are lower. I'm looking for the one silver lining out there that might say, yes, this is what bullish people can hang their hat on, that maybe delinquencies are not now starting to march towards 4%. And I can't think of one.
Yeah, everything you just rattled off, sounds like the fundamentals to me. And none of those are favorable for this reversing course. I think we're going to be in this for a while. And, the reality is now we're starting to see rent growth, basically be abated and in some cases retract. And I think that just adds another negative wrinkle to the story here.
So we're going to talk about a story that might require a whiteboard and some note taking because it's got some complications to it and some words that might be unfamiliar to some of our non-CMBS audience. So we're going to take it slowly, but it's an interesting story and it's worth some diving into.
Yes, this might be the one that it almost made my head explode. Describing it to other people, I think they had a similar reaction. We'll try to go through it very slowly. And certainly if you have any questions, come back to us. The story at hand relates to the Park Merced loan out in San Francisco. This is an enormous multifamily property out in the Bay Area, thousands and thousands of units. It first hit our radar in late 2021. We warned CMBS investors to keep an eye on this. At the time, DSCR had been under 1, occupancy had fallen about 15 percentage points, and the campus backs $1.5 billion in CMBS debt. That debt, the $1.5 billion, is broken down into $700+ million of senior debt, and then a whole host of B notes that total the $1.5 billion number. The reason this was on our short list today to talk about was that Emily Landis of The Real Deal out in San Francisco put out a piece in the last 60 minutes or so that talked about the fact that Aimco had sold the mezzanine loan on this particular portfolio for about 60 cents on the dollar. So the mezzanine loan was $275 million. They sold it for about $160 million. The buyer remains unnamed, but the twist that really was interesting to us was that Aimco put out a statement that said their loss was going to be paired by the fact that a swaption was purchased when this loan was made back in 2019 that was considerably in the money, and the sale of this swaption was going to help them reduce their losses from about 40 cents on the dollar to about 20 cents on the dollar. I would urge you to read Emily Landis's piece because it's really quite revealing. But what we think happened here, and we're speculating a little bit, was that in 2019, out of the proceeds of the whole loan and the mezz loan, a swaption was bought for about $16 million. In fact, $15.7 million if you look at the prospectus offering. This swaption, and we're going to put out a trading alert about this very shortly, the borrower purchased what is called a European-style swaption at the origination date of the loan with a notional amount of $1.5 billion. The strike price was 2.78% fixed. The effective date of the swaption covered the period from December 2024, which was when the loan is slated to mature, through December 2029. So basically, if I am reading this correctly, what happened was the swaption was bought to allow Aimco to have protection that if this loan couldn't be paid off, the cash flow to their mezz piece wouldn't be choked off by higher rates for the 5-year period after the balloon date. Now, I am speculating here, but that's what I think happens. My gut tells me that that is what we're seeing play out here. The in the money element of this swaption, remember they paid $15 million for it. I think they settled this swaption for something like 60 or 70 or $80 million. That's how much of this thing was in the money. The article spells it out precisely. But what this means is either when they sold their mezz note, they sold the swaption in addition to the buyer of the mezz note, and they now get the protection. But the buyer, under separate accounting, had to pay them $60 million for this swaption being in the money. Or they went back to the provider of this swaption and said, we no longer need it. We're not going to sell this off to the buyer of the mezz piece. We want to close out this transaction, write us a check. I think it's the former, not the latter, and it's 2 levels of accounting here. But it's evidence of just how complex these cap purchases, these cap renewals, and in this case, this swaption are coming. And I think the bottom line here is that because Aimco had the foresight to force the borrower to buy this swaption in 2019 with this extra 5 years of protection, that they were immunized from a much bigger loss than they might have seen, right? They have gotten another $50 million out of this by their foresight. And it just shows the magnitude of how much costlier a swaption would be today than then. This is probably 4 or 5 times the cost of what it took to put this in place in 2019. So I'd love for our listeners to come back to us to kind of add to the dialogue. If we have some thoughtful comments later on this in the week, we will talk about them on next week's podcast. So for Trepp clients, look for this trading alert either tonight, Thursday night, or tomorrow morning. It will give you what we think are both the facts and what we are speculating on what is happening here. But if you want us to get out that whiteboard a la Tim Russert in 2000 or whenever he first came out with that whiteboard on NBC News during election night, we're happy to have that whiteboard out.
Yeah, I don't know, whiteboard. I think I painted a Bob Ross while you were going through that. And so, but it's really interesting. It shows, to your point, Manus, for most of the discussion that we have on the podcast and most of the headlines that you read in the news, it's all pretty, black and white vanilla stuff. It's occupancies are, down, vacancies or sublease spaces up, cap rates are up, values are down. This gives you a little behind the curtain look at how complex some of these deal structures are. And when you have this type of exposure, size-wise, and in this particular instance, I mean, this property is really large. It's got 152-acre apartment complex, significant number of units, some market rate, some student housing, some affordable, some whatever. These deals get very complex very quickly. And when the market shifts as dynamically as it has over the recent months, some of these sophisticated, holders of these notes protect themselves. And it looks like in this case, they were able to take advantage of that. The unfortunate thing about this, just on a broad scale, is that there are probably a lot of owners that didn't have the foresight to do some of these things. So they don't have that additional saving grace to try to get some of that additional money back so that their losses are minimized. So really great story. I think you did an incredible job of walking people through that. When you read it on the TreppWire Trading Alert tonight, if you're a client, it's a really cool thing to see actually play out. We don't get to see the behind the scenes stuff like this as frequently as we maybe would like to.
And really terrific reporting by Emily Landis. I would throw this out to our listenership, because we've said before that when people buy these caps, they normally buy them just for that short period of time until from origination date to first maturity date. I'd love to know from some of our listeners how often they've seen something like this, which is buying protection for post maturity date. Is this the only time they've seen it, or is this something that savvy lenders have been doing more often than we know?
On this piece, man, if in that mezz position that IMCO was in, I think the all-in LTV on this was something like 84% at origination. So there was probably a little bit of trepidation going into the deal, knowing the size, magnitude, some of the challenges, and the fact that the loan to value on this was outside any type of reasonable norm for a project this size. I mean, the risks, maybe the upside they thought was rewarding if everything went to plan. But I think on this one, it maybe is a little bit of an exception. But I like you, would like to hear from the listeners if they have some additional color to educate us on that.
So let's shift into some of the property sector news. We'll continue with a little bit of retail news since we talked about retail earnings at the top of the pod. We saw that Bath and Body Works is spending about $300 million in capital expenditures, looking at about 115 real estate projects this year. And of those, about 90 of them are off-mall locations. So those are going to come at the expense of about 50 mall closures in 2023. And looking at the news just in the last week, we've seen a flurry of news on struggling malls. We've talked a little bit about the off-mall strategies of some of the other retailers. What's the significance to the malls?
Yeah, it's really an interesting time for the malls because it's like, just when you think it can't get worse, it seems to always find a way to get worse. So just in 22, we had Gap closing a bunch of storefronts in malls. Now Bath and Body Works announcing they're going to close a significant number of their mall-based stores, 50 of them in 23. And to that end, we had a couple of stories this week. Kelly Boucher had written an article about the Crossroads in St. Cloud, Minnesota. This is a struggling mall having an April deadline to repay $83 million in the mortgage balance. Doesn't look like that's probably going to happen timely, at least. Pennsylvania, there was a roundup of 10 central, Pennsylvania suburban malls and outlets across Lancaster, Harrisburg, Hershey, York. Across those properties, there were a total of 225 vacancies in the malls. So almost every single one of the malls had double-digit vacancies. And one mall in particular had 57, space vacancies in the mall. So, if we talk a lot about these concepts in the form of occupancy percentage or vacancy percentage, but if you strip it back and you actually look at how many spaces do they have and how many of those spaces just in a raw number form are vacant, it's pretty daunting in some of these cases. To have 57 vacancies in one location is really a troubling story. In Maine, this is an interesting tidbit. We don't see this very often, but a mall in Maine actually is closing due to non-payment of utilities. So imagine being a tenant in that mall, you paid your rent, you have consumers coming into your space, and you're unable to operate as a storefront anymore because the owner of the mall didn't pay the utility bill. So that's a new one for me, but something that's happened in Maine. And then lastly, in Idaho, the Lewiston Center Mall is going up for auction with an opening bid that's about 20% of the list price 3 years ago. So significant haircut that's going to be taken on that if it even trades. So, I think the Bath and Body Works story is an example, but I think, as evidenced here, it's not just Bath and Body Works. It's several of these traditional mall tenants that have decided outdoor open air shopping center type of structure is much better for them, especially if they can get into a grocery anchored, or Target or Walmart anchored type of center where they're getting similar type of foot traffic to what they historically got in a mall. But they're actually probably getting better consumer, more purchasing power, and ease of access for their consumers to actually get to their storefront.
So Lonnie, I have to fall on my sword here. This is my fault. I have been referring to Kelly from the Minneapolis St. Paul Business Journal for months and months as Kelly Boucher, but she and I spoke earlier this week and it's Kelly Bush. And so that's a bad on me. And going forward, we will have Haley go back to the dozens and dozens of times that we've referred to her reporting and make sure that we bleep that out and bleep in a correction. Can we do that, Haley? Is that Haley's shaking her head?
She's just going to have to live with the French pronunciation in all the previous episodes. Sorry about that, Kelly.
Well, I will say she is, one of my top 5 or 6 go-to people in the Business Journal world, along with Brian Bandel, Gloria Lloyd in St. Louis, and several others. I'm going to leave many out, but that just do great coverage of the commercial real estate sector.
And moving on to industrial, we're going to talk about the Solo Cup, everybody's favorite college cup.
Yes, we had a Solo Cup story, something that we're watching we don't know exactly how this is going to play out. And I'll take a detour for a moment. I just wonder if that mezz buyer at Aimco that was holding on to, that mezz loan since the beginning of COVID was going to the Solo Cup at lunchtime every day, right? That was, probably a very stressful 2 years for those as they watched occupancy fall. For those that don't know, Solo, the big red cup, ubiquitous at fraternity parties, right? The keg gets poured into the Solo Cup and so forth. They end up on the lawn. It's really ugly and nasty. But we did put out a story this week that this comes from the Real Deal. Solo Cup signed a big warehouse lease in the Chicago area for 1 million square feet or so. It's at 5183rd Street in Country Club Hills in Illinois. Why did this catch our attention? Because Solo is currently the sole tenant at 701 Central Avenue in University Park. That property backs a $47 million CMBS loan, which makes up almost 6% of a COM 2014 deal. The Solo lease at that existing place ends in September. As of the most recent servicer watch list notes, the tenant had not renewed, but negotiations were ongoing. This raises the stakes and makes this 2014 loan even more footnote worthy until more clarity emerges.
Let's shift into office. A lot of office stories. You saw this week the report released in a couple of media, actually, a Cushman and Wakefield report that said that about 330 million square feet of U.S. office space is going to be obsolete by the end of the decade.
Yes, that was a scary story. I saw it reported by Jack Rogers, but I'm sure others have picked it up too. Jack is of Globe Street. The report saying that by 2030, a huge percentage of U.S. offices will be obsolete. And it's hard to argue with that, given the current trajectory, given now we're kind of 2 full years plus into the work from home, really close to 3 full years into the work from home. The sublease space stories are unrelenting. The stories of firms downsizing from X to Y and Y being a third of what they had before. We saw that with Access in New York this week. We saw it with Baker Tilly in Milwaukee. Every week there's 2 or 3 of those stories, and it's hard to argue with the conclusion in that report at the moment.
Yeah, I would actually say by the end of the decade, it's probably too long. I think a lot of those office spaces are obsolete today. And interestingly enough, we actually had on our Tuesday morning meeting a discussion on obsolescence. So it takes the form of physical, functional, and economic, and we're seeing it play out across all 3 of those in the marketplace today. And then you're dealing with externalities in the form of higher interest rates, sublease that Manus talked about, et cetera. So I would say that's probably a fairly conservative timeline in terms of when these properties will be deemed by the market as being obsolete.
I was grateful that Lonnie didn't tie obsolescence to my own personal state here on the podcast. I think that my useful life the window is closing, let us say. And for Lonnie to be the gentleman that he was and not to point that out was quite gracious.
I would actually argue, Manus, that your effective age is way less. Like, I think you have a lot more remaining life left.
Well, we'll see. We'll see. The memory is almost full. We're gonna, we need a meaningful reboot.
And we saw a number of other office stories. We can start either with a number of follow-up stories that we did or some of the sublease.
Yeah, I'll start with the sublease. The worst of the bunch was Amazon is adding more space to the sublease market in Seattle. We've previously discussed the fact that Microsoft has put either 1.7 million square feet of space out for sublease or has announced they will not be renewing their leases. Amazon this week made available 140,000 square feet at Met Park North, which is at 1220 Howell Street in Seattle. The property is 190,000 square feet in size. Amazon has 75% of that square footage and has been there for about a decade. The story indicates that CBRE has the listing and the availability is current, that Amazon is either moving out as we speak or is already out. The owner is Hudson Pacific. They paid more than $100 million for the office in 2013. So I think the takeaway there is that more pressure on that particular zip code and that particular MSA. The one office to watch there might be the $100 million Hill 7 office that has WeWork exposure, also has a big Redfin lease there that runs until 2027, HBO in 2025, all make that a very footnotable asset out in the Seattle market. Elsewhere, very quickly, Phillips in Pittsburgh put out 74,000 square feet at Bakery Office 3. Calabrio, which is a workplace software provider, put 120,000 square feet of space out at the Steelman Exchange. That was another story from Kelly Bush. Minneapolis, we've noted before, and that entire MSA has been under sublease siege. And lastly, Uber in the old post office putting 50,000 square feet of sublease out there. We had previously reported that True Blue had put 80,000 square feet out at that property. The good news there is the property is 2.3 million square feet. So the sublease space there is de minimis. And that's all I have on the sublease category.
It would be really great if we could have some listeners give us some insight in terms of leasing velocity at some of these sublease locations. I mean, we obviously track the headlines, we get the square footage of what's being put up for sublease, but I haven't seen a lot of, actionable data around how much of that's being absorbed. And if so, what the real discount to, contract rent has been. If we could get some insight there, it would be really, really great.
And I'll go with one more, Lonnie and Martha. Martha, you're a New Jersey native. And Lonnie, you are a office data watcher. The head of the New Jersey Senate said, it's time to fish or cut bait with New Jersey offices. The head of the Senate said, so few people are coming back. It's time for them to slash their real estate footprint in the Garden State. What do you think there? I know you've looked at GSA leasing before, Lonnie. Is this the beginning of another trend?
Well, I think it's something that probably hasn't gotten enough coverage in the market at this point, in the sense that government tenancy across, the states at the federal level, et cetera, are a significant component to most office footprints. And so just as for instance, we're currently tracking about 7.3 billion worth of mortgage loans in the office sector that have some exposure to government tenants, and it's about 1,000 loans and about 1,300 properties. So, if states start making declarations that they're going to significantly reduce footprints, that could definitely have some downstream implications for just another layer of challenge on these office owners.
And you saw the story out of DC, the mayor there, Muriel Bowser, issued a challenge to the Biden administration that they need to get some decision on getting federal workers back to the office by a time to realign their property holdings. They have about 300,000 federal workers that make up about a quarter of DC's workforce. And those folks are still working remotely much of the time, and that's really hurt the city.
Yeah, I say good luck with that, DC Mayor. I think it's hard enough for companies that pay extremely high wages in the tech and business spaces to get people in. I think it'll be even more challenging to get office workers back in DC. It's not unlike New York and other major cities, Chicago, where commutes are long and expensive. And I think that might be pushing on a string.
Let's turn to hotels. The hotel industry has rebounded with a resurgence of travel, and RevPAR numbers, revenue per available room, has surpassed 2019 levels. But obviously the talk about inflation and corporate cost cutting might threaten the hotel rebound if any recession takes hold. So we've taken a deeper look at hotel and different MSAs. And just like we ranked the multifamily, our own analyst, Emily Yu, ranked the 50 largest MSA by lodging market performance.
Wow, that was a lot. But it's good because it means that we're looking at performance across MSAs, which everyone can understand and digest. And so, in this piece that's going to be released tomorrow, you'll actually be able to see the bifurcation of what we call the top 10 performing lodging markets. We have another exhibit that shows the top 10 lodging markets to watch. So I'll just run through a couple of these. All of these were measured across 4 loan metrics, so very similar to the multifamily piece that came out about a month ago. We're looking at weighted average trailing 12-month occupancy, delinquency percentage, debt service coverage less than 1, and weighted average net cash flow growth across each of the MSAs. So for the top 10 performing markets, number 1 was actually San Diego, Carlsbad in California. Las Vegas came in number 2. Rounding out the top 10, we had Riverside, San Bernardino in California. So not too surprising here. You had a pretty large mix of Florida and California markets, which for obvious reasons, probably were the first to rebound on the lodging side. A lot of business travel, a lot of great vacation spots in both of those locations. On the top 10 lodging markets to watch, again, using those same 4 metrics, not surprising, Houston took the top spot here, which Houston was one of our, multifamily markets to watch as well. Buffalo, New York was number 2. Cleveland made the list. Chicago, Minneapolis, St. Paul made the list. And rounding out the top 10 in a not positive way would be Philadelphia coming in. So some really good insight here. It's interesting to see of the top 10 markets on the best performing, delinquency as an example, the high watermark for any of those MSAs was 4.45% delinquency. But if you look at the top 10 lodging markets to watch, the high watermark on delinquency was Houston, which was about 43%. So definitely a tale of 2 markets there. And I think, the overall narrative has been positive for lodging assets coming out of the pandemic. But this makes clear that there's still some winners and some losers depending on some of the variables that we're able to track.
It was very interesting. I was getting messages from Donut Shorts yesterday, who covers the financial markets on Twitter extremely well. He was watching Barry Sternlicht's remarks, which I didn't see, but he summarized for me the remarks. And Sternlicht was very, very optimistic on the hotel market, much more so than other markets, according to Donut Short's notes. But he said something interesting, which I was surprised by. Paraphrasing Sternlicht, he said, the debt markets are kind of closed for hotels. Starwood is open for business and they're lending, but credit is tight for hotels, which I found a little bit surprising. I know it's tight for malls. I know it's very tight for offices right now, but we've seen that strong rebound in hotels. That took me by surprise a little bit, I have to say.
Yeah, I think the challenge for hotels, it's unavoidable for them, is just that the night-to-night business. So while they've had a quick rebound coming out of COVID and RevPAR numbers are better than they were in 2019 and occupancies have rebounded, just as quickly as those things came back, if the economy goes into a full-on recession or if we start seeing, more widespread layoffs and business travel gets reduced, I think you could very quickly see this sector start to struggle again. So I think from a lender's perspective, that immediate impact of COVID is still fresh in their mind. And so you're going to see, some tepid response from the capital markets for hotels, probably for the next couple of years.
And Trepp has published its 4th quarter Life Comps Total Index Report, which for those of you that haven't heard us talk about it in the past, it's a historic commercial loan investment performance index that looks at benchmarking commercial real estate mortgages held by insurance companies. So an interesting report that we publish quarterly, and it shows an interesting set of data.
Yeah, so for the Q4 total return index, that was an annual negative rate of 10.1%. But if you look on a quarterly basis, the loan saw slight improvement in total returns with a positive return of 1.9%. I think the challenge here is if the Fed, continues to be hawkish or more hawkish than what people expected, the market can expect, prolonged negative impact on commercial mortgage returns. We'll obviously be monitoring these. This is something that we do on a quarterly basis. So we have contributors that provide data. We go through this process of creating the total return index and benchmarks, and we put that out. So again, this is a piece that we'll release this week, and you guys can get access to that by visiting the website or emailing us at podcast@trepp.com. We'll be happy to share the report with you.
And a programming note, in celebration of International Women's Day, Trepp is hosting a panel featuring leaders in the commercial real estate finance industry. March 8th at 11, our own CEO, Anne-Marie DeCola, is going to be joined by a group of experts from Cohn Resnick, Deckert, CRE Finance Council, and the Bank of Tampa. And these executive women are going to be sharing their career journeys and experiences in CRE Finance. So if you're interested in attending that, let us know and we'll give you the registration information.
Yeah, some real heavy hitters in the CRE space. It's a great lineup.
Shout outs. Eric M. He was at MBA conference and listens to many of our podcasts in the gym or if he's going to class. Warren D., who wanted to give us some constructive feedback on some of our comments. Ann L. sent an article on hotel CMBS maturities. Jeff F. on Twitter gave us a shout out for our coverage on M&T's office debt. And a number of people that were interested in our Market Pulse webinar, Laura L. and Nick N. And interested in our office report, Linda Cole. And Gray Capital mentioned the multifamily report in their podcast. And, you know, for people who haven't been to New York City in the last 3 years, which is, I assume, a good number of our listeners, there's discussion about the New York City Council taking down the little dining shacks that popped up all over the city in the last couple of years. And if you are in a cold city, you probably have them there. They're a place for people to go eat during COVID. They're not the best looking little things, but they were the only option that we had when the restaurants were closed. Well, it looks like they're looking to shut those down.
It's a little bit too late for me. I'm still suffering from PTSD. Last weekend, I drove my son, who was moving from South Carolina, to Brooklyn in a 10-foot Ryder truck. And if you've ever driven in one of those things, you know, the mirrors stick out about 24 inches on either side. And it's really a two-man job. My son had to give me, you know, constant play-by-play about where the 10-foot overpass was coming. I had images of blowing one of these things up and having to deflate our tires to back out of it. And then you go down one of these narrow Brooklyn streets where on one side there's a police paddy wagon and on the other side there's an Amazon truck. And you can almost hear the mirrors rubbing against the mirrors of these trucks on either side. So it may take me another 3 or 4 weeks to kind of shake off the heebie-jeebies that I got from that drive.
You don't want to drive in Europe. That's all I got to say. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.